that we pull for credit. And what he explained to me was we use FICO uses an older version for mortgage. So they use a classic score, they call it. It's 5, 4, and 2. So they kind of rate it, they score it differently and they call it something else. But FICO has updated all along. They come up with these new updated ways of scoring. And so when you pull your score on some of these platforms like Credit Karma, My FICO, you have a score 8, which is the newer version. And that score is going to be higher. It's going to be different. So people always get confused about, everything they look at is a different score. So it tends to be an issue because they kind of look at us like, well, look what you did to my score when you pulled it. And that's not the case. So I try to explain to people in the simplest way possible that FICO has a different scoring for different things. If you look at something like My FICO, which is a company that you are a credit, place that you can go to have your credit pulled, you do have to pay for it. It pulls it without a hard inquiry, and you can look at the different scores. So it'll tell you this is your score 8. That's not what we use for mortgage. Then it'll give you the credit card score, and then it'll give you a auto score, what you use for auto. Then it will give you your the mortgage score, so the version that we will use for scoring credit. So again, like I said, inquiries only count as 10% of your score. It could be anywhere from 5 to 15 points for us to pull credit. Now, if somebody has good credit, again, it's not going to put them in a position where they're not going to qualify. The other thing that I like to remind people of, or tell them some people don't know this, we score, like they worry about interest rate, because that's what they worry about with credit score. Interest rate, right, is the big thing. We do interest rate, and they do it in increments. So it's like 760 to 790 is going to be, or even over 800 is going to be one score, one interest rate. It's not going to change. If you're 760 and yesterday it was 780, it's not going to change the interest rate. So the interest rate kind of goes in increments. So if you're over 700, 7 to 740, it's going to be one interest rate. 740 to 7, and it tells us when we pull it, like, even if your score was, 755, your interest rate is not going to change, if you have a 7.4, whatever the score is. So there's increments that we look at. And so that's something that I like to tell people too. One of the other things I tell people, because again, they want to know what's going to happen when you pull my score. I tell them, like, the one thing that will affect your score, and again, this could be reported at any time during the 30-day period. Collections are a big one. Late payments are huge. These things are what really drop your score. So if you have a collections on there because you haven't paid a bill, even if it's medical, we don't have to pay those off to get you qualified, but it does count. It's on your report. Maxing out credit cards, so being up to limits and having high balances. And I did talk to somebody also about this with having open credit. That's okay. Having a limit of $7,000 or $8,000 and not having a payment on that, that's open credit. So we look at that as a positive. So if you have credit cards and you don't have any balances on them, and you have open credit, we're going to look at, well, you have your total debt is, let's say, $4,000, but you have a open limit of $20,000. That's good. You want to be under that, like, 30%. So that's another thing that we talk about too, is like keeping those credit card payments down. So paying your own collections is another one, because we do talk to people about this too, because I do see a lot of credit scores with collections. What happens with those is people will go in and pay those on their own. So let's say the collection was from 2017, and then now in 2021, they decide they're going to pay that collection. Great. Now you don't have the payment, but now it's reporting as a new collection for 2021. So it's no longer a 2017 collection. It's reporting. It's like the last date of activity is what they look at. So that actually is detrimental to your score, because now it still shows up as a collection. And that's where Stephen Robert comes in, where I will send people to him, because he can take that collection and get it off of your score. Get it off of your credit report, where we can't do that on our own. They're not going to take it off for us. He's got verbiage that he sends to them. It is a cost to the borrower. He does charge. I don't get into that with him or with the clients. I let him take care of all of that, because he knows what he charges. He does a free consultation, which I think is awesome. He talks on the phone, gives you your plan of action, that doesn't cost you a dime. So if there are things you can do on your own, he'll tell you, here's what you can do on your own. You don't need to pay me for that. Do this and your score is going to jump 50 points. So that's one of the things I love about this guy, is that he's not out just to get he's not going to ask you just because he talked to you. He's not going to ask, their clients for money, which I think is important. So like I said, the My FICO is where we look for credit report. We look for credit score. If you think your score, these, clients think their score is low, but they want to know first before I pull it, because once I pull it on my, in my system, I have to wait 4 months to pull it again. So if they do that and then they work on their credit score by, let's say, paying down some balances, and their score jumps up 50 points, I won't be able to do anything about that for 4 months. So what I sometimes recommend, if they need to talk to Stephen Robert, he will recommend myfico.com. You do pay $30 to have your credit pulled, but at least you'll get the score that we're going to use. So if you see that it's 650 and you're like, wait a minute, I got to pay these balances down, and there's really nothing crazy on my credit report, I just have high balances, let me pay these. It'll bring my score up to maybe over 700 over a few, over a month, maybe, or two. And that's something that, he will advise. And I usually, if somebody needs to work on credit, I usually just send them right to him and let him work on it. Because like I said, I know the basics, and I can definitely advise people, and I try to get their fears kind of at bay, because I think it's one of the biggest concerns for people. So again, like I said, the FICO score that we use was from 1989. The mortgage companies have not taken the new technology and kind of put it into play yet. So unfortunately, we're still using that like classic score, which again, if you're paying your bills on time and you're no collections, and you don't have maxed out credit cards, your people's credit scores can be really good, so those are kind of like my points. So we can kind of have a conversation if anybody has any questions, and if I don't know answers to something, I can absolutely get you those answers, because Stephen Robert is, like I said, a text message away.
Hi, Kristen. It's Niels here. I'll put the camera on so you can see my face.
Hi.
Hi, how are you? So I have a question for you. You said that it's a 10% impact if you pull credit on one of your customers, but how quickly will those 10 points go back up? Like in what time span? If I pull credit today and let's say my credit's 700 and it goes down to 690, how quickly will it go back up to 700?
So I want to say these inquiries could stay on your report for quite some time, but if you're not pulling, if you're not doing hard inquiries constantly, I don't think it would take much time for it to come back up. I could ask Stephen that question, the actual time frame of that. I'm not positive.
I actually have a client asking me that question right now. If they're going to pull credit.
Yeah. I see. It's such a concern for people, and it really is like, like I said, if people have good credit and they're not maxing out credit cards, it's the people where their credit is iffy that you're putting a hard inquiry on there, and that's where their scores are going to drop even further. So if you have somebody that's paying their bills on time, that doesn't have high balances, they don't have collections, and their scores are in the sevens, it's the people who are sort of like, well, I don't know, I haven't been doing all the right things. Those are the people that I think it impacts more, because it's just another layer of, issues on their credit report. Do you know what I mean?
Yeah. And I have another client who says to me, she's a renter, and she's like, I'm looking at my credit score every other day. Mm-hmm. I told her, why? And she goes, oh, I'm trying to clean it up. I have it at 650 now, and I'm trying to clean it up. And I was always under the impression, if you keep looking at your credit, it's going to impact the score in a negative way as well. Was that wrong advice?
I don't think it depends on where she's looking at it. I mean, she's not really she's not putting a hard inquiry on it to go on Credit Karma. So if she's looking at Credit Karma every day, that's not going to do anything, because she's just pulling up her score, and it's only the 2 scores. So it doesn't count as an inquiry on those websites.
Okay. Thank you.
Kristen?
Yeah.
Hi, it's Mary Russo. I just put my face on too for better. Anyway, nice to talk with you. So they can pull their My FICO as much as they want, and it won't affect it. You said it reflected their credit score by 10%. Is it 10% or 10 points?
No, 10% of the score. So
So if the
they,
score is 700, it could go down 70 points.
no, 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 no. It's saying that in total over the, what they look at for score, like they look at, if you go on like Credit Karma, and
Mhm.
and I don't recommend people go on Credit Karma because it's not the right score for our purposes. But
Right.
if you go on Credit Karma, it will list what is high, like in order of high impact. Like if you don't make your payments on time, that's going to impact your score. Like it's a high impact. So
Right.
what they're saying is like the total of all of the things that impact your score, 10% of that are hard inquiries.
Oh,
So it's
okay, all
not
right.
like it actually
You said
impacts.
10%. I thought when somebody applied for mortgage, their score goes down 70
Oh, no,
points.
no, it's 5 to 15 points. And really it depends on, like I
Okay.
said, how many different things are on their credit report. If this person has a bunch of collections and late payments and I pull a hard inquiry, it's probably going to affect it pretty highly. You know what I mean? Because it's
Okay.
already been affected by other
Okay.
things.
All right, thank you.
Yeah, you're welcome. Anyone else have any questions for me? I tried to cover everything that I could in the concerns that I've heard over the years, and the information I have gotten from I was going to have him come on, but then I figured I wanted to meet all of you guys first and talk and get to know everybody. And it's hard on Zoom to get to know everybody. I like these meetings in person. I can't wait to get back to the office. But and honestly, if nobody has any credit questions, I'm happy to, if anybody has any other questions that I can answer, I'm here. So
I think we're really interested in learning more about the different types of loans.
okay.
FHA comes up a lot. I was just talking to someone about getting a construction loan because they're doing a renovation.
Yep.
Understanding the different loans, what are the pros and cons of each,
Yep.
and so on and so forth. I think that would be really helpful.
Okay.
Conforming versus non-conforming, et cetera, et cetera.
Got it. Okay. So we'll start with conforming loans. Anything under 601,450, that is Fairfield County. So this is are you guys all from Stanford or are you guys everywhere? Just
Stanford.
Stanford. Okay. So Fairfield County is primarily where you're working?
Yeah, in Westchester County. Yeah.
Westchester County. Okay. So Fairfield County, 601,450 is the limit. That's at that point. Once you get to 601,450, it goes to a jumbo, which is non-conforming. So you have conforming loans and non-conforming loans. Then you have Fairfield County has high balance, which is still conforming, but it's just the rates are a little different. And honestly, high balance rates are better than the regular rates now. And they moved that number up to 548. I'm going to double check on that number, but they just moved the high balance. So from zero to, you're not going to get a loan for zero, but from let's say 75,000 up to 548, I believe that number is a conforming loan. Then you get to 548, and only in Fairfield County do we do high balance. From that number to 601,450, then it becomes a jumbo loan. All of these things I talk about kind of as they come up. Those loans are processed all of those loans are processed pretty much the same. We do have different guidelines for jumbo. The credit scores have to be higher for jumbo. Once you get over that 601,450, the credit score has to be 680. I mean, things have changed so much with COVID too. Like everything's so, we used to be 720 with COVID. We couldn't go under 720 for jumbo. Now they're going down to 680, some lenders. So it's really a case by case, situation that I discuss. Like I'll tell a borrower, I know you're up here at this purchase price. Your credit score is 670. We need to keep it under 600,000 because you're not going to qualify for a jumbo product. So I kind of talk to people about what they can do based on the situation. If they're in the conforming, it's fine. We can go down to 620. Used to be 580. So conforming loans, 620 is the credit score. I'll answer any specific questions you have on those types of loans processing or whatnot. But now we'll move to FHA. FHA is a federal housing authority. It's a government funded loan. It was intended for lower credit scores and lower income. So we look at a debt to income ratio, which I'm sure you all have heard 100 times over. Debt to income ratio. What is your debt to income? So for a conforming loan, you can go up to really close to 50, which 50% of that monthly payment is your income is 50% of that monthly payment. So we go up pretty close to that, and we can still get it approved as long as the credit is there. You know, they don't have a lot of debt. We have to look at the whole picture. With FHA, we can go up to like 55, 56 debt to income. So it allows a person with lower income to have the same purchasing power as a conforming loan, basically. So I switch people to FHA if I know their credit scores are lower. They also give them a break on the rate. So if you're FHA and you have a lower credit score, your rate's going to be much higher for conforming. So we'll go to FHA. Now, the only issue with, and I say issue because some people have a problem, the mortgage insurance. There is PMI with an FHA loan that is life of the loan. It doesn't matter if you have, you know, $70,000 left on the loan and your loan to value is, you know, 50%. It doesn't matter. That mortgage insurance stays for the life of the loan because it's a higher risk product. It's somebody that has lower credit and lower income.
What means PMI, Kristen?
Oh, the mortgage insurance? Oh, you want to know what that is? Okay, so mortgage insurance is something that is implemented for anyone for a conforming loan that is under 20% down payment. So it's just for the lenders to be able to, it really is for the lenders to be protected if they default on the loan, because they look at anybody who doesn't put 20% down as a higher risk client. So higher risk clients, they need to have that they need to have that mortgage insurance they're paying on. Basically, if they default on the loan, the mortgage company, I believe, gets paid 80%. So they will be taken care of. And FHA is a higher risk product for people with lower credit and lower income. They're more likely to default on their loan. So what happens is, because of that, there's PMI throughout the life of the loan because they can happen anytime. That's sort of what their thinking is. And also the FHA appraisals are a little bit more strict, a little bit more in depth. They look at things more. They look at foundation and cracks. They look at peeling paint. They look at health and safety issues, because if this person defaults on their loan and the bank has to foreclose on it, they need to be able to sell it. So they are very strict with how they look at FHA, appraisals. So people tend in this market, I'm doing FHA loans right now, surprisingly, but it's very difficult for somebody to get an FHA loan approved. I mean, to get an accepted offer. Am I right? I mean, if you guys are doing FHA, listing agents are like, nope, not doing it. Don't want to take that because it's a risk for them to have it not appraised or to have issues that they have to fix. And it's a seller's market. Sellers don't want to fix stuff, maybe if peeling paint or whatnot. So FHA tends to be an issue right now. I have gotten FHA loans. I'll talk to listing agents and call and say, this person is qualified. We're doing FHA for so-and-so, whatever reason. I don't give them any real personal information, but this is why we're doing FHA. I do try to ease their mind a little bit. And I did get an FHA appraisal to come in over asking. So it can happen.
Okay,
yeah, go ahead.
Sorry to interrupt, but so PMI is an insurance when the borrower, right?
Yep, borrower
defaults on the loan. It's not like, because like in Belgium, where I come from,
yeah,
we had some sort of balance insurance. So like if I would die,
yeah.
the insurance pays everything.
Oh yeah, no, it's not. Yeah, no.
It's some sort of a life insurance.
Yeah, right. So this is basically to protect the lenders.
Does that exist here? That kind of balance insurance?
I think that would be like a life insurance policy, and you'd probably have to set it up so that, or some sort of a life insurance, you'd set it up where they would, or a will, some sort of a will. I would think that would be like a legal issue, like an attorney would have to draw something up. I think we do wills here where if something were to, if you were to die, that your house or your property or whatever would go to the next, the beneficiary. And
Yeah, but that's a will, but I mean, it's an insurance that, that insurance pays the balance of the principal.
That would be an insurance agent question, because they would be able to tell you if they have something where they would pay the balance of the house. I mean, I guess you could set up a life insurance policy that would cover the balance of the house, and maybe they could do, I honestly don't know if there is such a thing that would just go to pay the balance automatically. So I don't know that question, but
okay, thank you.
I have two questions. So my first question is there a minimum credit score for FHA loans?
Yes, 620 right now. It used to be 580, but COVID, it's 620. Everything is 620 now across the board. It's horrible because, you feel bad when somebody has like a 618 credit score and you're like, sorry, I've had it happen.
So even for the conventional loan, you said it was 620 as well, correct?
Yep.
Okay. So with the conventional loan, is it always a minimum down payment of 20% of the loan?
Nope. Yes. Nope. That is actually something that is a total misconception for people. So we do as low as 3% down for conventional. You have to qualify for the 3% down. Your income can't be over a certain limit. So I would look that up for that particular person. So if they're over the income limit for 3% down payment, you can do as little as 5%.
Okay.
So we do a Home Ready, Home Possible loan. Those are two conventional products, similar to like the FHA. They give you a break on the rate and the mortgage insurance. And they come with an income limit. So I know, like in Norwalk, for example, I worked at an office in Norwalk. So I did a lot of Home Ready, Home Possible loans in Norwalk. $96,500 is the income limit. So if they make $97,000, they are not eligible for a 3% down payment. They have to go to 5%. But if they make under $96,500, if they made $95,000 combined income on the mortgage, they would qualify for a 3% down payment. This loan is awesome. I do it all the time for people. I love it because the rates are lower. The mortgage insurance is lower. It allows for this lower down payment, but they have to do a home buying course that I'm finding is taking people forever to get it done. So it's kind of holding up the loan process because we need the course certificate to get this loan product through. But we're trying to make sure that people are on top of like, get this done because this will hold it up if you don't have it. But yeah, so the misconception of the 20% down payment, that's not true at all, but you do have PMI, anything under 20%, you have this mortgage insurance. $525, okay. Yeah, so the 520, 580 used to be the credit score for FHA before COVID. So we could go to 580. It had there were different requirements, like you'd have to put a 10% down payment. The 3.5% was not allowed with a 580, but at least you could do the loan, Any more questions?
Sorry, just take one step back. So I'm still thinking about these conventional loans or these conforming loans. So in Westchester County is 448,000, and in Fairfield it's 601 something.
You're saying for jumbo?
Yeah. What is the conforming threshold in Westchester?
Honestly, I'm not licensed in New York, but I'd like to be, so I should probably find out. Westchester, I'm just Googling it and seeing what I come up with. Westchester.
But in Fairfield, it's 601, right?
601, 450 is Fairfield County. Yeah. So I try to keep people under that if they can, depending on credit score, because the rates change a little bit for jumbo. I got to be honest, the rates are so low across the board. So they're not changing too drastically. I mean, there was a point where when we were in the 2s, that jumbos were still in the 3s. So it was a definite difference there. But right now the rates are pretty consistent across the board in the 3s, like low 3s.
Okay. Well, thank you for that.
Yeah, of course. Jumbo.
Where could we find out some more information about the Home Ready and Home Possible loan?
Oh, well, I can You can look it up. I mean, you can Google it, but I can absolutely get some information on that and maybe send it out to the office. I can send it to Rick and maybe he can pass it along. I'll do that. Let me write this down.
Okay.
Any specific
That would be great.
I can answer for you now. Yeah, so I mean, the basics that you want to know about Home Ready, Home Possible, and it's really, you know, the only thing that you really would need to know as an agent, because I can get into all the details with people about how it works. It's the same as a conforming loan. It doesn't change that it's a conforming loan product. It's just what it offers is the lower down payment, but it comes with an income limit. So if you said, all right, I have a client who has 3% down payment because they were going to rent, but now they want to buy and they need this 3% down payment. They're going to buy in Norwalk, or they're going to buy in wherever, Stanford. You can go into Home Possible or Home Ready income limit on Google, and then a map will come up, and you can put the address in or just the town, and it'll give you the median income. And it'll say Home Ready or Home Possible, whichever one you look up, because one's Fannie, one's Freddie. Doesn't matter. They're both the same as far as that goes. Put in the address and it'll give you the Home Ready or Home Possible income limit is 85,000. Like depending on where you go, like Danbury's a little lower. Danbury, I think, is 85,000. So I just go in whenever I get a client or an agent asking about this loan. I'll go in, say, where are you looking? I'll put in the town or the address if you have it. And I will say, all right, well, if they make under this amount, you know, because I don't have all the towns memorized, and I do it just because I don't want to be wrong, you know, and just tell them one thing and then not, you know, have it not work out. So I'll go in, put it in, and then I'll pull up what the income limit is and be able to let them know, hey, you qualify for a 3% down payment. This is your income, you know. It's definitely a product I use a lot, because not everybody has cash on hand to put for a down payment.
Kristen?
Yes.
It's Mary again. What about for co-ops?
We do not lend to co-ops.
Okay.
Not many people that do. I came from Ravis Mortgage and we didn't do it there either. So okay. Yeah, that would be like a broker. I would find a private broker to do that.
Okay, thanks.
The only loan I didn't hit was the construction loan. I'm just looking at this from Neil's over here. Construction loans. So that there are two kinds of construction loans. We have there's really three, but 203K, which is the FHA version of a renovation loan. Then there's the home style renovation, which is the conventional version of the renovation loan. They're both almost identical. The 203K FHA version, you will take, let's say the purchase price is $400,000. You're going to put in an offer, you get an offer accepted, but you know this house won't pass FHA standards. This person needs to put a 3.5% down payment. So you go in, I'm doing this with somebody currently. This house would never pass an FHA appraisal. So we're going in as a 203K. So what's going to happen is a contractor goes in before anything else happens and says, these are the things that need to be done. Well, the contractor is going to give them an estimate of what needs to be done. So with a 203K loan, we have a HUD consultant, and he acts as the inspector. He acts as the appraiser, comes in. He says, all right, you want to do the kitchen, you want to do the bathrooms, you want to do this, but the necessities in this house to make this pass an FHA appraisal are this room, this paint is peeling, it needs to be redone. Or this bathroom is not functional and it's not going to pass for whatever reason, that needs to be done. So the FHA minimum standard of livability items need to be done first in one of those loans. And it's a perfect loan for somebody who only has 3.5% down, wants a house, doesn't have cash to throw in to do all these renovations, and can do an FHA loan because they can go in and fix all the stuff that the FHA appraiser would say, no way. So basically what happens is you get the list of what you're going to do, the renovations, you get the costs from the contractor. He'll tell you an estimate. It's going to cost you $20,000 to do all the stuff that needs to be done, the stuff that you want to be done, $20,000. There are other fees involved, and that will be addressed as you go through the process. We have a HUD consultant that needs to be paid for. There's they take money for an escrow account in case they break down a wall and they find mold or something. They have to have some money, like escrow money, in case there's issues. So in total, let's say it's 25,000. I'm just making up numbers. So now you're at 425. That becomes the purchase price. And from 425, you put 3.5% down on 425 now. So that's your down payment. Now you get into this, you have to have a contractor that's willing to come in, do the work before getting paid. So he'll come in and do like the kitchen, let's say. He'll do the work. The HUD inspector will come in, the consultant that you've hired now will come in and say, he's done everything he needs to do. It's up to code. He didn't skimp on anything. He didn't skip a step. He did what he needed to do. It passes. Great. He will get paid for that job. The bank will pay him. So it's kind of good in the sense where, you know, the contractors know they're going to get paid. They just have to be able to come in and do it. Then they move on to the next project. They can do up to 5 projects and the bank will pay them after each project. So that's kind of the overview of a renovation loan. The other good thing about the renovation loan is you could walk into a house that you're paying $400,000 for, and it appraises at, let's say, I don't know, 395, 390, the before construction, before renovation value. What the HUD consultant is going to do is he's going to give you the after renovation value as well. So you could walk into a house with equity, with just putting 3.5% down, 425. If he says, oh, this house is now, once you do all this renovation, this house is going to be worth 500,000. Like you know, they walk into a house and they have equity immediately. So it's actually a really great product. Home style renovation is the conventional version. It's a minimum of 5% down payment. And basically it's the same thing. The difference with home style renovation is that you can do luxury products. You can put in a pool. With FHA, you cannot. You can put in like a tennis court or a basketball court if you want to go crazy and make it like a, you know, a beautiful, you know, backyard that you can go play any sport you want. So that's kind of the difference between the two. They generally are the same. I mean, it's you got to have a contractor that's willing to do the work before getting paid, which is the big one. But we, you know, the lenders that we use have contractors that have done these loans in the past and are fine with it. So I'm just trying to kind of look through these.
So I think Marcel asked in the chat, we were discussing this yesterday in one of our meetings, is there a max that they will allow you to do the renovation? Like, is there a $35,000 cap
No, there's
for renovations or no?
There's a minimum. Well,
okay.
You can't go over that jumbo mark because the jumbo loans become a different product. Like the Webster is one I know does the jumbo renovation loan. So you'd have to keep it under a certain limit. I will get that limit for you. It's not, I want to say home style renovation can go up to, used to be 726. It may go up a little higher now. I'll find those limits for you, but I do know that at one point up in those higher ranges, it does become the jumbo construction loan, which is a different product. And that one, I don't have a lot of information on that one, but I know that there's a lot more that has to come out of pocket for those. Like it's not, you know, the FHA, the 203K and the home style are everything's financeable. So if you know, after you close on a rent 203K loan, you have 6 months to finish all the work. So you have to close and then the work starts. If that house is not livable, you can mortgage up to 6 months of mortgage payments, meaning if you have a $2,000 mortgage payment, you can finance 3 months of that because you're like, I can't live in this house without a bathroom and kitchen for, you know, so I'm going to go rent somewhere for 3 months, but I'm going to finance my mortgage payments because I can't pay my rent and the mortgage on this house. So they allow you to finance, you know, your mortgage payments too. So there's a lot of sort of in and out, you know, there's a lot of detail and a lot of things that we sort of address, but it all is situational. It kind of comes when things come up, we kind of address it. Do you know what I mean? So I'll find out that limit, where to steer the client to get a pre-qualification if they are not working with a mortgage broker or bank. Steer them to me. I do pre-approvals. I'm going to kind of throw this out there. I what I feel works for pre-approvals is either an email or a text message is huge now. Everybody's texting. It used to be the group email. I would be put on an email, an introduction would be made. This is Kristen from Guaranteed Rate Affinity, one of our preferred lenders, however you want to word it. And then I immediately respond. I am on my computer or I'm on my phone 7 days a week, and I'm not joking. I answer almost immediately. Hi, nice to meet you. Happy to help. Thank you so-and-so for the introduction. Happy to help with a pre-approval. Let's set up a conversation, and then here's my link in the meantime if you'd like to start on the application process. 99% of the time, they're going to fill out the application. If they don't, not a big deal. I still have a conversation. Once they fill out the application, it comes to my email that they've started it. Then when they've finished it, I get another email. It's done. I go in pretty immediately and I look at it, especially in this market. If you need a pre-approval, you need a pre-approval, and you need it now because you're going to miss out on a house that's going to be gone in 4 hours. So I do pre-approvals very quickly. I get those out as fast as I possibly can, with the exception of self-employed borrowers. Sometimes they get a little complicated. So that may take a little more time. I'm not going to take a week. I'm going to take a day, 24 hours, if necessary. But for the most part, my pre-approvals are fast. I get them out because I don't want to sit on them. Number one, I don't procrastinate. I don't like it. Makes me anxious. So I get those out as quickly as I possibly can. And it also, if I don't, that person's going to go somewhere else. I mean, there's mortgage brokers everywhere. So I want to get the business. I have to send out that pre-approval. So I just saw Diane asked about pre-approvals. So that's kind of how I do it. As the text message works great too. I just talked to somebody before I got on here. A text message was sent. Thank you for the introduction. Let's talk. Great. I can talk now. Oh, condos and FHA. This is a good one. So can you guys still hear me? It says my internet connection is unstable. We're good?
I hear you fine.
Okay. So condos and FHA, that's a good question, actually. Condos are complicated when it comes to FHA because they have to be FHA approved. Not all condos are FHA approved, as I'm sure many of you know. So I try to steer away, go conventional for anybody I possibly can when they're buying a condo, because it can get very, it can definitely get complicated. What we do offer is a single unit approval.
And now, hello? I guess we lost her.
She looks frozen.
You can hear me, right, Eric?
Is that Niels?
Yeah.
Yes, I can hear you, but we can't hear Kristen anymore.
Another question I need to get asked is, a lot of people ask me this question: what are the cost estimates of doing a mortgage? Someone said, like, and what are the total closing costs? I think someone told me 2.5%.
Hi, I just got kicked off and I'm back on. Sorry, can you ask me that question again?
Oh, I was going to ask at some point. I think you're still answering the other question, but I'm getting these questions about, what is it going to cost? What are the fees involved in getting a loan? Let's say they buy a house and they need a $500,000 mortgage. Like, what are the fees, the estimate of fees that we could quote to our customers?
Yep. So I always say it depends on the loan amount. So a $500,000 loan amount, you have attorney's fees. Once the application goes in, I pull fees and I can tell them estimated fees. We look at closing costs, which we have our flat fee of $11.90, $150 application fee. So it's like a 12, I want to say maybe it's $12.90 in total. I'll have to get you the exact amount, $12.90 in total for our fee to process a loan, to originate. We do a flat fee. Some lenders do a percentage. Some lenders will do a percent of the loan. We don't do that, which I think is great. You have to pay for the appraisal. This is all part of the closing costs. Then you have all your attorney's fees. Those are the attorney's settlement fee, could be $1,000, could be $1,200, depending. They get to pick their attorney, so they can pick the attorney that has the lowest settlement fee or whatever the case may be. So the settlement fee plus the recording fee, title insurance, owner's insurance, it's a bunch of fees can run you $5,000 average for, attorney's fees, and then our fees. So 5,000, 5,500. I've seen it at 6,000. Again, it depends on the loan amount and the town, because they all charge different fees for attorneys. The attorney's fees are most of the closing costs. And I give my clients will get a breakdown of all the fees the minute they go get into an accepted offer. I will tell them what the fees are. If they need a breakdown, I'm fine to do that before they get an accepted offer. The other thing with the closing costs are prepaids. You have to prepay 1 year of homeowner's insurance upfront, either at closing or before closing. It's up to the client. That could be, $1,800. It could be it depends on the quote. So I put in usually $2,000 as on the high end for homeowner's insurance. So now they're at a year of homeowner's insurance. Then the mortgage companies require 3-month cushion. So they require it's 4 months, 3 months cushion, and then another month, because when you close a loan, you skip a month of the payment. So they need that month, because when it comes due, they can't have 11 months of insurance. They need 12 months. So they ask you for that month at closing. Then you have your taxes. We look at initially very high 9 months of taxes. That's what we ask for to put in escrow. So if you have $10,000 in taxes, that's going to look like a very large number. So closing costs could look like in the beginning with a $500,000 mortgage, it could be 15, 16, 18,000, depending on taxes. And that's at the high end, and we always estimate high. Then we get the insurance quote. That number gets replaced with the actual insurance. Then you have the final fees at the end. The attorney will get together with our closing department to do final fees, and he'll say, oh, we only need 3 months of taxes or 4 months of taxes. That number will drastically change towards the end. So it's never as much as and it can be, but I've not really seen it be as much as we quote in the beginning. But they could run you like, $18,000 depending on the loan amount. Sounds crazy, right? Oh, let me go back into the chat. Make sure I answer everybody's questions. The condo FHA question, did I finish answering that or did I get kicked off? I'm putting my contact information in the chat. I'll put my email and then my phone number. This is my cell phone. Feel free to text me, call me anytime. I'm always available. If I don't answer right away, I'm usually within the hour, we'll call back. I don't like to let things sit, so I don't ignore phone calls. Not a procrastinator. Any other questions, comments, concerns?
Hey, Kristen. Whoa.
Yeah.
Kristen, could you put that that number up again? Thanks.
My phone number?
Yeah, the information. Thanks.
Oh, yeah, I just did. Do you want me to do it again?
Yeah, thanks.
Yep. I'll do it right now. That's my number. And then 203-521-2251. Yep. Did I send it to everyone? I did, right? Okay. I just want to make sure. Okay. Kristen.Polack@grarate.com. If any questions come up at all, call me. Feel free to call me. I'm always around. I'm happy to help. Send clients even if they just want to talk. I always, it's always good for, if you have a client that's with another bank, say, hey, get a second opinion. They can always get a second opinion with me. And knowing now that they can have their credits pulled with me it kind of eases their mind a little bit about having, being able to shop for rate.
So one more quick question. I don't even know if you answered this. I think Marcel had asked, what's like the lowest credit score to get a loan I guess she met a lender and they could do like a 520 credit score. So what are the pros and the cons for like approving a loan for like 580? Is the interest rate going to be high?
Yes, the interest rate's going to be high, and at under 580 and under, they're going to require a 10% down payment. It's not going to be 3.5% if you're doing FHA. Conventional, I'm not sure we'll go down to 580. I have never done one under 600. So we were able to do 600 at one point for conventional, but that is now gone away since COVID. Hopefully all these things will start, the guidelines have definitely eased up since COVID. Hopefully we're coming out of this. We're all going to get vaccinated and not wear masks anymore. I just saw that people were not wearing masks. It's crazy to even think it, but hopefully all this stuff will be coming back. You will find lenders, private lenders. There are people that'll do 580. I've never done 520. I've only done 580. But you will find like private mortgage brokers that work as a sort of independent. There are lenders. They're like the lenders that sort of do all these non-conforming products. So they're out there. Unfortunately, we can't do that right now, but I will absolutely let everybody know when we get down to 580 again, because we're missing out on a lot of people.
So like, I know for like first homeowner buyers, like there's different programs for first homeowner buyers. Could you like explain that a little? Like I've heard there's programs that will help you with your initial deposit. Like how does that work?
Okay, so that would be a Chappa loan or a Chenoa loan, as those are the acronyms. Those two loans, so Chenoa we do through guaranteed rate, which I would actually prefer over Chappa, because Chappa is the Connecticut Housing Financial Authority. It's through, like, we have to kind of broker it to them. They take it and they do it. The good and bad with that one, I mean, it's always a great product to have, because if somebody doesn't have a down payment, they offer a down payment assistance program. You have to qualify for it though. You have to meet the income limit. You can't make too much money. You can't have money in your bank account and just want to borrow a down payment. So they kind of look at all this stuff. The debt to income ratio has to be under 43 for a lot of these products. So there's I have tried to put people in those loans. They're not always the easiest. You do have to qualify for both payments. It's sort of like having a first and a second. So you have to qualify for the first mortgage, plus you have a payment for the second mortgage. That's Chaffa. With Chenoa, which I think is a, it's the almost identical product, but we will do, and I will, don't quote me on the exact amount, but I think it's 30 something payments. If you make 39 payments consecutively without being late on your payments with the first and the second, they'll forgive the second mortgage. So they allow you to go through, 2 years or whatever it is, whatever the number is of payments on time every month. And then they'll forgive the second loan, which is incredible, because now you have a second mortgage you've gotten for your down payment. And now all you're going to have is a first mortgage. I will tell you that the rates were higher because obviously they need to make their money somewhere, the lenders. So their rates are a little higher for that one. I couldn't tell you exactly what they are right now. I could, make some calls and find out like what the average rate is for something like that. But those are the products, but you have to fit the box. Like you have to be under the income limit. You have to show no money in a bank account, and they'll find it because they look everywhere. You can't hide anything from lenders. So it is a great product. Home Possible is a first-time home buyer product, but you don't have to be a first-time home buyer to do that. So that's kind of why I like to use those products for people with lower down payments, because it does help you with your rate for sure. Does that answer your question, Erica?
Yes, it does. Thank you.
Okay.
I'm trying to I want to do like a homeowner buyer seminar, but it's just a lot of information to it. So I'm trying to learn as much as I can.
I will go. You want me to do it with you? We can do it together.
Thank you. I appreciate that. I will definitely reach out to you.
Yeah, definitely. Anyone else?
I'm good. Thank you so much, Kristen.
You're welcome. Oh, there's everybody. I should have put you guys on gallery view this whole time. I didn't do that. Now I did it. All right. Well, I'm here. Like I said, feel free to give me a call. Happy to talk to clients. Happy to answer any other questions that come up throughout the week or weekend or whatever. I know Saturdays and Sundays are busy. Like I said, I don't leave home without my computer. So if you guys need anything, please, even Sunday, call me. I'm here. All right.
Thank you, Kristen.
Thank you guys for coming. All right. Talk to you soon. Is Rick there? Is he there still or no? All right. Bye-bye, everyone.
Thank you.
Bye.
Thanks again, Kristen.
All right. You're welcome. Have a good day, everybody.